Welcome, everyone. Thank you all for joining us today. My name is Gershon Margolis. I am the founder of Imperial Advisory. We are a fractional CFO firm. I'm going to start by thanking Brittany for putting this entire thing together, and thank Jerry for joining us today, our featured speaker. It's going to be a lot of fun. All right, I'm going to introduce I'm also going to mention a few of our CFOs who are here. Then I'll introduce the firm and introduce Jerry, and then we'll get going. So in terms of our CFOs who are here, we have Jim, who is one of our CFOs over here. Thank you for joining us, Jim. We have Mark, who is one of our CFOs. Jim is a CFO, has a lot of experience in apparel and retail. Mark has experience in manufacturing as well, a lot in the medical space, and Steve has service experience working with a lot of equipment rental and other interesting companies. And if there's anyone else from our team, I don't see you on the screen, but Barry might be here, and he has a lot of amazing experience in retail, manufacturing, and service as well. And again, thank you, Brittany, for putting this whole thing together. Anyway, so now, like I said, I'm Gershon Margolis. I'm the founder of Imperial Advisory. We are a fractional CFO firm. So in a large business, the CFO is often one of the most trusted advisors of the CEO. And in a smaller business that doesn't necessarily have a need for a full-time CFO, using a fractional CFO really gives the CEO and business owner a lot of the same benefits for a fraction of the time, and fraction of the price. And that's why it's called fractional. Anyway, we pick up where accounting leaves off, and we help with all sorts of financial analytics as well as strategy, guiding the accounting department. So not doing the accounting, but we'll often manage the controller and all the things that you would expect from dealing with banks, investors, whatever, all the things you'd expect the CFO to do. On the other side of the house, we do consulting. And so our consulting is sometimes working for CFOs and sometimes working for other people. One of the things that we do in our consulting practice is mergers and acquisitions. So we help people who we might not, sometimes we are the CFO, but sometimes we're not the CFO, and they're looking to make an acquisition. And so we help with, and you can reach out to us, we'll talk more about this another time, but we help with analyzing the businesses. We can help on the buy side, we can help on the sell side. We recently uncovered what we think was a Ponzi scheme. You can either check out our webinar about this from about a month and a half ago, or reach out if you want to learn more about Ponzi schemes. We do not recommend investing in them. Anyway, but often when people are looking to buy businesses, they need capital. So sometimes you have investors. I spoke with someone like that yesterday. No, actually, no. Someone I spoke with yesterday had the capital. They're not looking for investors. They're not even necessarily looking to borrow money. But I spoke with another fellow yesterday who's has a business that he's starting. He might be too early for SBA funding. I told him he should come and grill Jerry on that, like if he would qualify. But anyway, the point is, often when you're buying an established business, SBA backed loans are a way to go. And for that reason, we thought that this was a great topic. And who better to have than Jerry? I've known Jerry for many years. He's become a friend. And at one point, we were quasi-competitors in a prior life for him, but we weren't really competitors, and we still had a lot of fun together. And remember what you used to say? That you like the past, I like the future, and we meet in the present. But anyway, Jerry is has a lot of great background in accounting and finance, and now he is running an amazing business. I'm going to let him introduce himself, and then we're going to jump into the topic. So
yeah, sure. Thank you, Gershon. Thank you, Gershon, for having me on. I really appreciate the opportunity, and great to meet the entire Imperial team. Yeah, competitors. I guess you could say we were once competitors, but just a brief background about myself. So I was an auditor for 5 years, auditing private companies, small, medium-sized businesses on the East Coast primarily. Before I jumped ship, I kind of decided to leave the public accounting sector, became the CFO of a large distribution company in Jersey. Before then, at that point, I probably was there for about 13 months. I went out on my own. Initially, I set out to be more like a fractional fractional CFO, kind of what the Imperial team does. I started seeing this massive demand where you had a lot of good, solid companies, rapidly growing companies, profitable companies, where they needed help getting financing in place. They just had trouble telling their story, going to the bank, telling a coherent story, putting together a clean package for lenders that kind of allows the qualitative factor to drive with the quantitative factor. So I started getting involved in that. And to be honest, as an auditor, the primary reason why we audited companies is because these companies had loans, lines of credit with conventional lenders. Banks are not handing out money for free. There's reporting requirements. Oftentimes, banks require that companies get audited annually and that the auditors provide an audited set of financials. So, between my auditing days, the CFO experience, I kind of, recognize that there's this value that companies have in that, in the lending, the banking relationship. It's kind of crucial to their growth and their operations. So I started helping, clients initially. Actually, I approached a friend of mine and said, "Hey, do you need more financing?" And I kind of tried to understand, like, why he couldn't access the financing and desperately needed to grow. And he was kind of my first client, my first guinea pig. That was actually the first SBA loan that we did. We refinanced a lot of debt he had, restructured his balance sheet, got him access to a fresh, brand new line of credit to help him with his growth. Then I realized, like, hey, there's something here, and things kind of snowballed from there. So we're doing this for about 6 years. We don't just do SBA financing. We do conventional revolving lines of credit. We do SBA term loans, which is obviously the topic of this conversation, this webinar. But that's what we do. We love being part of small, medium-sized businesses growth story. We've had a lot of success at doing it, and I'm looking forward to hopefully imparting some knowledge on this call, helping entrepreneurs get a better understanding of SBA financing and how that takes place in an acquisition.
All right. Should we get started?
Let's do it.
All right. So, people need to borrow money, right? I'm buying a business and I need to borrow a few $1,000,000. Why do I need an SBA loan? Well, how is SBA loan different than anything else?
Okay. So just to first of all, I'd just like to welcome two members of my team that are also on the webinar. We have TJ Kubowitz and Chaim Roth, experts in their own right. I'll be leading and answering their questions, but they're on the call. Okay, so I guess first of all, I just want to preface, if you don't have experience with SBA lending, SBA 7 or SBA 504 lending, and you think you know what SBA is, just like take that, scratch it. You don't know anything about SBA lending. There's a lot of misconceptions, and I think people are also stuck in that pandemic era. I guess some say we're still in it, but they're still stuck in that PPP, that economic injury disaster loan kind of mode. Where the SBA is giving out free money, they're giving out grants, they're giving out 30-year loans at 3.75%. That's done, and hopefully we never see that again, right? I think we're on the same page about that. SBA loans essentially predates the pandemic. Besides for the SBA giving out loans to disaster affected areas, by physical disasters, and they're still doing that today. They about 40, 50 years ago, they started this program where essentially they were going to back loans from regular banks. Now, the purpose of that is banks historically are conservative. They're ultra conservative. They're very risk averse. And, think of things in the context of a small, medium-sized business, rapidly growing. Financial reporting is not so strong. It's constantly evolving and changing. Lenders weren't really lending to smaller businesses. So the SBA kind of stepped in and said, hey, what if we guarantee a percentage of these loans you'll make to these small businesses? And, and that kind of, so that's kind of been around for a long time. So it effectively started, it's push lenders to make loans to businesses that they otherwise wouldn't lend to, or deals that would have like deemed too risky, industries that would have been deemed too risky. And really the SBA's goal was to drive economic growth, job creation, and things like that. So that's that, so again, so whatever you know about SBA loans from, 2020, 21, 22, forget about that. This is a completely different world. And really we're going to focus on what's called the SBA 7A program, which again, just to be clear, is a loan that comes from a regular bank. Think of your regular brick and mortar banks. There are some SBA only lenders, non-bank lenders, but to simplify, think of your regular brick and mortar banks making a loan to you as an entrepreneur to buy a business, and that loan has a 75% or greater guarantee from the SBA. So if you think about it in the context of a business acquisition, it's kind of one of the riskiest deals a bank can do. You're talking about some companies have been around for years and years and, established a lot of positive cash flow, positive financial reporting. But at the same time, it's still a small enterprise. A lot of them are owner operated or seller operated, right? So you're going to have a new buyer come in, take the business over, so that in itself just has a tremendous amount of risk. And then on top of that, also, oftentimes the selling business doesn't have substantial hard collateral. So the bank is effectively giving the entrepreneur a loan to buy a business with a very unsecured position. So they're kind of relying on the SBA's guarantee, which in most cases is 75% of the loan amount, to make these loans and fund these business acquisitions.
Got it. Okay, so I basically I show up at the bank is nervous, they don't want to lend me money. So the SBA is going to tell the bank that if I default, they'll pay the bank and then they come after me, essentially.
Essentially, yeah. And by the way, this brings up like another good point. Like everyone wants to know, and I think we discussed this beforehand, right? Like, why does it have to be an SBA loan, right? Why can we like? There's no conventional options out there. The short answer is in a business acquisition, change of ownership, there really is no conventional option out there. Yeah, when you're looking at buying a business, 30, $40 million in enterprise value, it's a $20 million purchase price. Right, that's a different world. That's more like investment banking, PE backed deals and things like that. But in this space, I would say in the $500,000 purchase price range up to the $10 million purchase price range, there really aren't conventional options. The conventional options are really essentially family offices, or funds that are looking to back these deals. Are usually looking to get some equity, get a piece of the pie, interest rates very high, convertible debt. So the short answer is SBA is really the only conventional option. Now, just, there are thousands of lenders out there out there. I can't speak for every single lender, but this is just based on our experience and what we've seen over the last 6 years.
Interesting. Now, something you just mentioned, I'm curious. Can a family office get SBA to back their loans, or are they only backing bank loans?
So to make an SBA loan, you kind of have to, it's a process, it's a process. So conceptually, it wouldn't be so simple just for a family office to get the SBA to back their loan. I mean, the process, so there's different, right? So there's something called a PLP lender, which is a big point that, I just want to throw at the audience here. There are preferred lenders under the SBA 7A program. What the preferred lending status means is that they've made a certain amount of SBA 7A loans, and therefore they are allowed to approve the loans in-house without having to go to the SBA to get the loan approved. So in the United States, there's over 1,500 lenders that are actually preferred, that have that preferred status and designation. Now, most of those lenders don't really do a lot of SBA loans. Like the bar to become a preferred lender is, I believe you have to do about 10 SBA loans in a year to get that preferred designation. On top of that, there's thousands of other lenders that are still utilizing the program, to make loans, but they actually have to go to the SBA to get the loan approved directly from the SBA. Now, even those that are not preferred, there is a status. It is a status to be able to make SBA loans, a very in-depth and deep process. On top of that, also, there's a very limited amount of licenses that the SBA actually hands out to non-bank lenders. So to answer your question, family offices cannot and most likely will not make SBA 7(a) loans.
Well, thank you. All right, so let's get into the nuts and bolts. How big, right? How much of a loan can I borrow? What are the terms? What is what does this loan look like?
Absolutely, yeah, absolutely. So the cap on SBA 7(a) loans is $5 million. Okay, and that's tracked by guarantor. Now it is kind of a ever-changing environment. It's constantly evolving. The SBA changing up rules. There has been some changes in this regard, but to simplify things, the cap on SBA 7(a) loans is $5 million. And that's tracked by guarantor. And whoever is guaranteeing an SBA loan, which is important to note, their guarantee is an unlimited guarantee. So even if you're a 20% owner, 25% owner in a business that you're guaranteeing in an SBA loan, you're and let's say that business or the acquisition, you had a $2 million loan, you kind of that $2 million works against you in terms of the SBA $5 million cap, the full amount of the 2 million, even though you're only a 25% owner in the business. You can get as many loans under the SBA's rules. You can get as many loans as you qualify for, up to that $5 million cap. So conceptually, today you can go buy a business with $1 million 7(a) loan. In a year from now, you can go buy a second business with a $2 million 7(a) loan, and you still have, even after that second acquisition, you still have additional availability of another $2 million approximately, right? Because you would have paid on some principal at that point on the first loan.
Right.
So the cap is $5 million. Now, there are lenders that will, a very small pool of lenders that will make, they'll give the buyer a $5 million 7(a) loan. And then on top of that, they may offer some conventional financing to pair up with the SBA loan to kind of achieve, and close larger deals. So if someone's looking at an $8 million acquisition, they shouldn't get scared off by the fact that, hey, I can only get a $5 million SBA loan because I got to go raise $3 million, let's say, or whatever it is, whatever's needed to raise to cover that gap. Now, the lenders that do those kinds of deals above the $5 million cap, again, there's very few select lenders that do it. And they only they do it for really strong, solid deals, which we'll get into most likely soon. But just to simplify, $5 million cap. When there's no real estate involved in the loan itself, these are fully amortizing 10-year loans. Okay. So they're 10-year loans, which is also, when you look at conventional financing, not business acquisition financing, regular conventional financing, terms are generally 5 years, sometimes less, sometimes a little more. So 10 years actually considered a long term for a deal without any real estate involved in the deal. So you have a 10-year fully amortizing loan. Interest is kind of, the SBA kind of dictates the max a lender's allowed to charge. Most lenders use prime as the benchmark rate when determining interest rates. The max the lender is allowed to charge is prime plus 3. Okay, so today prime's at 8.5. You're talking about 11.5% potentially. Now, the spread that the lender is charging above prime, that really depends, A, on the lender, B, the strength of the deal. And again, we're going to get into it too. When we talk about strength of the deal, it's very holistic, how lenders evaluate and underwrite deals. There are some lenders that will price deals based on, the treasury, but those lenders are kind of there's a very small pool of lenders that use the treasury or other benchmarks other than prime. And those lenders are what I call the slam dunk lenders, where you got to check every single box to get those deals through. So what I tell borrowers is you have to expect a prime plus lender and assume a rate of prime, +2 and up potentially.
Thank you. Quick question on the guarantor thing. if there are two different guarantors, can we get $10 million or that
No,
only?
no. So that's kind of what I was touching on earlier. They tracked the $5 million by, the cap is by guarantor. And what I meant by that is that, so because everyone's signing an unlimited guarantee, they kind of have the same cap essentially. So if they're completely, let's say someone's looking to buy two companies, and he buys company A for $5 million, his spouse could buy company B for another $5 million, but you can't have two people achieve more than that $5 million cap basically.
So if myself and my partner both, if I have a $2 million loan against business A and my partner has a $3 million loan against business B, and we want to buy business C together, the max we could borrow is 2 million.
Exactly. Yeah.
The whoever of us has the least goes by the least capacity.
Exactly. So something we'll get into is kind of anyone who has more than 20% in a deal has to guarantee. So the way to possibly achieve going above that cap is to if you have a group of partners and everyone is retaining ownership under 20%, there's creative ways to get past that $5 million cap. But again, you got to be creative, and there has to be enough partners in the deal and things like that.
Now, if there were 10 people each looking to buy a business and they decided to go in together and they each one bought a tenth of each business, does nobody guarantee any of it?
No, so every SBA loan has to have a guarantor. Okay, now the 20% is the hard and fast rule, right? So greater than 20%, SBA rule is that whoever has more than 20% has to guarantee. Now, if everyone is less than 20%, someone still has to guarantee. Now, on top of that 20%, the SBA lender will evaluate who is the person that has control here. So even if you had, five partners and one of them is greater than 20%, the others are not, the SBA could still say, hey, not the SBA, the lender could say, we want, this other person to guarantee as well. So just, kind of just to throw in here, maybe this is a good point to say this, the SBA rule book is over 400 pages long, the SBA SOP. Yeah, it's crazy. And there's a lot of vague language, gray areas. And the one thing that the SBA requires lenders do is they have to do what's called prudent lending, which that in itself is kind of very vague. So they have to abide by the SBA rules. Lenders have to develop their own underwriting criteria. And it's kind of a mix of both. And that answers the question that most people have, like, hey, how is this lender different than the next guy? And that kind of answers it, because every lender has their own credit box, deals that they like, deals that they don't want to do. So even if something is SBA eligible, it doesn't mean you'll have a lender that will back it. It's the SBA setting, right? They have what's allowed, what's not allowed. Now, what's allowed is really the minimum, that's allowed. It's still at the lender's discretion to determine if they want to back that or something, or not. So, back to this question about the guarantors, the rule is 20% or more has to sign a personal guarantee. The lender can still say, hey, but we still want this person to guarantee as well, right? If that person maybe is exerting control, or maybe he's the one that brings financial strength to the deal. So 20% hard and fast, but it doesn't preclude the lender from not requiring other owners to guarantee.
Thank you, Jerry. And this is supposed to be educational, but since I'm the host, I'm going to give a plug for Jerry over here. This is why you go to Jerry, and Jerry helps you get in front of the right lender the first time.
There you go.
Because that's
Thank
all.
you. Thank you,
You're
Christian.
welcome. That's okay. So does the SBA care how much I pay for a business? As long as I'm not borrowing more than 5 million, what if I want to overpay because
Yeah,
I like the seller?
that's a very solid question, which we'll get into valuation, I hope, assuming the clock doesn't run out.
This is the valuation question.
Yeah, I guess this is the valuation question, right? And the short answer is, like, look, I got to throw this in here as well, right? The silver tsunami is a big topic. A lot, millions of baby boomers retiring in the next couple of years. they don't necessarily have children that want to take on the business they could pass it on to. And a lot of them have like strong, healthy businesses that are up for sale. And, it's kind of a good time to jump in, try to find a business to buy because there's a lot of activity now, and that level of activity is only going to increase. Now, what's happening is you do have a lot of sellers that are not really preparing for a sale. They haven't worked with Imperial Advisory to do some sell side consulting, and they think their company's worth $1 billion, and on paper their company's worth maybe $100. Their financials, their tax returns don't show diddly squat, and it's really a big challenge. I can't even tell you how many deals we look at that don't pencil for any loan amount at all.
Can,
But
can I
sorry,
can I jump in for a second to give an
yeah,
example of that?
sure.
We were working with a client on the buy side. They were looking at this business. It was doing 10 million in revenue, healthy revenue growth, the whole deal. But there were problems with the margins. There was tons and tons of problems. By the time we were done with our first cut, the client's like, if they gave us this business for free, do you think we should take it? And the seller wanted to value the business at like $10 million. Anyway, sorry. Keep
Yeah, I
going.
mean, this is really the day-to-day of what we see. We look at a lot of deals, and most of them do not pencil. Some of them kind of just have these inherent issues. They're really not good businesses. But then you also have businesses that they are good businesses, but the sellers don't have clean books and records. Their focus of, filing their tax returns is to pay the least taxes possible. So we're gonna break even and we're gonna show losses. Ultimately, that's like the moment when they're trying to sell and things get challenging, when they realize that they really shot themselves in the foot. And if there's any established business owners here listening, I mean, just remember that is a major impact of how you run your company, how you report internally, how you report to the IRS. There's going to come a day when you're going to want to sell your company, and you need to prepare for a sale. And we're talking about 2-3 years in advance, not waking up one morning and say, hey, I'm selling my company and it's worth X. Now, to get back to your question, so probably 3-4 years ago, right? If a company's selling for $10 million and on paper they're only worth $5 million, and the buyer is willing to bring equity to the table, more equity, or the seller's willing to offer a substantial amount of seller financing, there's very few lenders that would have done that deal because it's still got to make sense, even though their loan underwrites, let's assume, seller financing, was on standby for many years. The buyer is bringing tons of equity, well capitalized. It just doesn't, they have to make the case to the SBA that they acted in good faith when making that loan. And when something, if paying $10 million for a business is worth $1 million, kind of gets challenging. But lately it's kind of the tides have been turning a little. More lenders are getting on board with, just making sure that their SBA loan is well documented. If there's seller financing that's on standby for a few years, that's fine, and if you want to bring more equity to the table, that's fine. But it's, you still got to cross your T's, dot your I's. So to answer your question, if you want to pay more for the business, you have ways of structuring it. There are ways to accomplish that. There's definitely more lenders that are buying into that.
Okay. So I have two questions. Um, the first question is, and tell me maybe this is good for the end, but how does that really work? So and my second question is going to be, what is the valuation that the SBA is looking at that they're going to limit? But my first question is, if something is over that valuation, however we get to that valuation, and someone is paying substantially more than, as whatever you called it, what the SBA views the business as being worth, what the bank views the business as being worth, what does that mean for our market? Is everyone just overpaying? Because I know that interest rates are up dramatically, which means it's not like you're getting in with cheap debt service. So if debt service has doubled or tripled in the last few years,
Yeah.
and the business is weaker overall, like how does all this work? Are we just heading for a crash? Did we discover this here today?
Yeah, I don't know. That's a good question. I mean, it's definitely impacting. When you say the market, you mean the business buying, selling market, or you mean the overall state of the economy and things like that?
Mostly the business, but that could be driven by the overall state of the economy. But I just mean like if people are paying debt service is costing twice as much and people are valuing businesses at twice as much, that doesn't make any sense.
Right, right. So look,
And
there are
that the banks are
definitely
letting it go is just
look, there are definitely legitimate reasons to overpay for a business. Deals where those legitimate reasons can actually be applied are far and few between. But just take a simple example, okay? You're a manufacturer that manufactures computers, right? And the person you're buying chips from is selling their company, right? And it could be a no-brainer for you to buy that business and overpay for it because you kind of control the supply chain, you're controlling pricing. I'm just saying there are legitimate reasons why you'd overpay for a business. Um, I mean, look, each deal has to be evaluated on its own merits. I think oftentimes people get very excited about upside, but the question is what that upside means for the buyer. For example, right? So if they have a company like Imperial come in do a Q of E, and that Q of E determines that, hey, their financials or tax returns were understated, they're really, way more profitable, they have way more cash flow. That in itself could be justification for overpaying for a company. So there's definitely legitimate reasons why someone would overpay. But 100%. I mean, look, banks are definitely, more conservative. They're inherently conservative and more cautious. And if someone's overpaying, even if the bank's open to doing the deal, it's got to be supported by a strong valuation. They may want to see a quality of earnings report. And they're definitely going to cross their T's and dot their I's on a transaction like that.
so you're saying like the ROI and the quality of earnings report could be very high because that will enable you maybe to borrow double the amount of money, which reduces your out of pocket or
Yeah,
whatever.
potentially. The ROI even on a dead deal could be high in a QOV, right? Because if the QOV determines that the seller's running a Ponzi scheme,
Yes.
to me that ROI is tremendous, right? It's definitely painful to pay a substantial amount of money to have, to do due diligence and then find out that it makes no sense to go into the deal. But that's really what the point of the QOV is for. Um, so yeah, look, a Q of E is definitely something that's recommended on a smaller deal, right? Having a Q of E done definitely, increases your costs and, you have to determine what level of due diligence you're going to do to see if it makes sense. But the more due diligence you can do, the better off you are.
Okay. Thank you. So now the other half is, or the other question was, what is called overpaying for a business? Who
Sure.
makes up those rules? How does that
Sure. So I'm
how
gonna
does that go?
backtrack a little if you'll allow me to. So like the question is really how do lenders look at target companies, right? You're a business buyer, you found this company, you think it's a rock star, you want to, you put in an LOI, you want to get financing. So there's two aspects, and again, remember, SBA lending or SBA underwriting is very holistic. So we're just talking about focusing on the target company and what lenders are looking at. There's two things that they look for. They look for cash flow, they look for valuation. If you don't have both of those pieces of the puzzle, I'm not saying you don't have a deal because there's other ways to mitigate valuation gaps and things like that, but it will be very challenging to get things across the finish line. Two things you need: cash flow, valuation. So the first thing is what is cash flow? To simplify, it's what's considered excess cash flow. How much EBITDA is there in the business? Earnings before interest, taxes, depreciation, amortization. How much those discretionary earnings is there? Now, the way they value, the way they look at that, and the way they look at the cash flow and the valuation is they're going to ask for 3 years of tax returns for the seller. Okay, the SBA requires at a minimum that the seller provide the most recent 3 years of filed tax returns. And that is really where the core analysis lies in the tax returns. And, obviously at this point we just started April in 24, sellers may not have 23 tax returns. So they'll want to see 2020 through 22 tax returns. And obviously 23 financials because they do want to see that the business, they want to see recent financials, and especially if we don't have a filed return for that year, they're going to want to see those returns. But still, the core analysis focuses on the tax returns. Now, when they look at seller's discretionary earnings, so they generally want to see the most recent 1 to 2 years of excess cash flow to support the proposed debt that they're giving. Okay, now I don't want to get too granular and nuanced. We're trying to simplify things here, but basically they're looking for debt service coverage. Okay, the ratio that they're looking for, most lenders want to see 1.5 times on an acquisition in the most recent 1 to 2 years. They want to see 1.5 times seller's discretionary earnings to cover the debt. So if your annual loan payments that they're proposing to give you is going to be $100,000, they want to see $150,000 in seller's discretionary earnings to kind of get the loan approved. Okay. Now, if you have 1 year, it's still possible to get the deal done, but naturally, the less reliance you could place on the most recent years, the harder it is and more challenging it is to get it done. So again, 3 years tax returns, they're evaluating cash flow to determine if there's enough debt service coverage. Okay. Next thing is valuation. Now, remember, they're relying on the tax returns to do their preliminary analysis. And I say preliminary because ultimately, as part of the closing process, they're going to order a formal valuation from a third-party valuation company, and they cannot lend more than the actual valuation of the company. So that's an important thing to note.
Who pays for that, by the way?
Sorry?
Who pays for that formal
The
valuation?
buyer pays for that. The buyer pays for that. Now, so when they're looking at those tax returns, again, they're looking at seller's discretionary earnings and applying a reasonable multiple of those seller's discretionary earnings. Now, part of what they'll also factor into that seller's discretionary earnings is they also have to factor in a potential salary for the buyer. So even though you're adding back the seller's salary, seller's payroll taxes, seller's benefits, maybe the buyer, they likely will need to factor in a buyer for the salary as well. So that's going to impact the number that they're using to apply a multiple to. Okay, now most businesses, from what I've seen in my experience, trade at a multiple of 3 to 4 times of that seller's discretionary earnings. Now, yeah.
3 to 4 minus the buyer salary. Let's say there's 200,000 a year of seller discretionary earnings. How much are they? They're going to care about like 100 of that and multiply that by 3 to 4.
So how much of the buyer salary is needed is kind of it's like a moving target and varies on a deal by deal basis. It depends if the buyer has outside income through themselves or through a spouse. Depends if like, okay, are they going to be like the owner operator? Like that dollar amount of how much a lender is going to have to take into consideration for the buyer's salary really varies. It could be 50 grand, could be 200 grand. So whatever your SDE number is, you got to reduce that by the buyer's projected salary. And it's something that a lot of buyers do not take into account. So they're like, hey, we got a great got a great seller's discretionary earnings here. Here's the multiple's great, purchase price is appropriate, and then the valuation comes in lower because they're missing out on that crucial component.
Could you totally ignore it if it's just an investor? If the buyer's an investor, not an operator?
Here's the deal. Okay, the SBA 7A product wasn't made for investors. It wasn't really made for investors. So they don't want to hear that a buyer is an investor, right? They want to hear that the buyer is the operator. He's going to be there running the show, taking things over, keeping things smooth, be there for the transition period. Naturally, they're also not stupid. They understand that, like, right, buyers usually there to kind of take things to the next level, and perhaps they're going to look to do more acquisitions, to do, what they call roll-ups, and things like that. But they don't want to hear that someone's just an investor. You don't want to get on a call with a lender. Yeah, I'm an investor buying a company, and I'm going to be in Cancun, and the company is in California, and I'll be there once a year. It's not something lenders want to hear. Now, they're going to apply back to the valuation. They're going to apply a reasonable multiple. In my experience, 3 to 4 times is a normal multiple. As you start heading above, closer to 4, it starts getting a little bit more pricey. Now, I'm not telling you there are niche industries that have higher multiples, but most industries trade at a multiple of 3 to 4 times. So like I always say, like, if you're close to 3, you're at a healthy multiple. Now the big thing that I find with valuations is that you'll have a lot of sellers that will say, hey, here's my tax returns, right? And tax returns show like break even, right? And maybe there's a seller's salary on there for 100 grand, but then the seller provides a list, Excel spreadsheet of what they call add backs. Now, what are those add backs? I don't know. It could be the seller's running his personal mortgage through the business. It could be he's running his personal grocery shopping. We see these things all the time, where sellers are running personal expenses through the business, other discretionary items. Now, some of them could be truly discretionary, but lenders generally don't take them into account. And the larger that list of add backs are, it gets very challenging, right? Like lenders are looking to rely on financials, on tax returns. They're not looking for a seller to provide a spreadsheet of a bunch of junk add backs. It brings into the question of like how reliable are the financial statements of the business? How reliable are the tax returns? We're not even getting into legalities. But if you're like, if you get a deal, returns show nothing, financials don't show anything, and then you get this 30-item list of add backs, like the second I see that, to me, that's like red flag number one. Usually those deals kind of just fall by the wayside. Now, there are some lenders, again, really small pool. We don't work with those lenders or these kinds of deals because it just, there's too much unknown. There's no certainty of anything. They'll say, okay, get a quality of earnings report. We'll rely on the Q of E. Right now, again, reminder, like Q of E is important. It's something we definitely recommend. The question is the lender relying on that Q of E? Most lenders do not. They're relying on the valuation, on their own analyses. But in this case, there's a lot of add backs. Perhaps Q of E will help justify the purchase price. Some lenders will say, okay, so the seller's running all these personal expenses through the business. Show us the backup. Give us the substantiation. But again, if the more add backs there are, the chances of a lender getting on board are just really, really slim. So when talking, just to quickly summarize, I'm talking about, valuation or how lenders, view, underwrite target businesses. They're looking at cash flow and valuation, utilizing most recently filed tax returns, and interim financials. And if you don't have one or the other, it gets very challenging, which brings me to my next point. Now, sometimes these add backs that I just mentioned, which lenders don't like to see, could be enough to like get the lender to support the cash flow of the deal, but not the valuation, right? So lenders are kind of more lenient in the sense of like, hey, okay, like we kind of understand, fine, like the buyer's going to come in, he's not going to run all these personal expenses through the business. So we could kind of make the cash flow work. But again, for valuation, that's not going to work. So what do you do when a business is overpriced? Okay. The easy answer is renegotiate the purchase price with the selling price with the seller. Right now, the chances of that happening are usually very slim, especially when you have some crazy business broker that's trying to get his maximize his commission. So the chances of that happening are very slim. So the next two obvious things are bringing more equity to the table, which kind of to an extent defeats a little bit of the purpose of the SBA program, which kind of the intent is to get maximum leverage on something like this, which I didn't mention yet. We'll get to. The next thing is to bridge the gap with seller financing. Okay. The seller is allowed to finance part of the deal, and to the contrary, it kind of strengthens the deal. Even where you don't have a valuation gap, having the seller finance a portion of the transaction really helps solidify the deal. Because look at it like this, right? Let's say there's no seller financing, the deal pencils, the buyer closes on a business today. The seller flies off to Turks and Caicos tomorrow. Okay. You got to come in on day one and you got to operate this business. Like, how are you, moving through that transition period, right? How are you, like, you got to learn the business, there's I would say 3 to 6 months of a transition period, and you want the seller to be there to assist you. Having the seller finance some of the transaction will leave some skin in the game for the seller. He's going to want to make sure that you're successful, to make sure that he's able to recoup, the amount that he financed. He wants to get that money out ASAP. So having seller financing is tremendous, regardless of valuation or not, but it is a tool that is often used to mitigate valuation gaps. Okay. So that's a way. So if your business values at $1 million, the bank's only willing to finance 850,000. you only have $100,000 to put down, the seller could finance the other $50,000. Now, the terms of that seller financing is subject to the SBA rules and the lender's comfortability, which again we'll get into. The clock's running out. But this kind of brings to mind one more point which I didn't mention. I should have mentioned it earlier. How much can a bank lend? Obviously, we know about the $5 million cap. The short answer is that a bank can lend 90% LTV, assuming that the cash flow is there and the valuation's there. Okay, so in $1 million deal, to simplify things, not factoring in closing costs and all that, the bank can lend $900,000. Okay, so conceptually, the buyer has to bring 10% to the table. Now, here's the really nice thing about SBA. And this is where more seller financing comes in. The SBA allows some of the seller financing to account for some of the buyer's equity injection. Okay, so even though the bank can only do 90% subject to LTV and valuation, let's say the buyer only has $50,000. So on $1 million deal, the bank can only finance 900,000. The buyers bring $50,000. The seller can actually finance the other $50,000 that is required as part of the buyer's equity injection. Now, here's the kicker. If the seller is financing part of the equity injection, there are rules. Previously, the rule used to be that the seller cannot see a red cent of that money until the SBA loan is fully paid back, okay, after 10 years.
Wow.
The rules recently changed where the SBA said that if the seller is willing to put that note on standby for 2 years instead of the full 10 years, then it could be counted as part of the equity injection. So they kind of saw the value in sellers offering more financing, buyers putting down less, and perhaps retaining their liquidity. And they kind of eased up on those rules to make it more palatable to sellers to offer financing in deals where the buyer, wants to conserve liquidity or doesn't have the means to pull together the full 10%. So it could be super favorable. And again, even if a deal works, even if a buyer does have the ability to put down the full 10%, it may still make sense to do that because then you're keeping the seller with some skin in the game for at least 2 years. It's a really nice benefit. It's a really great way to structure a deal. And then once we're on the topic of seller financing, a lot of questions I get, and maybe you were going to ask this, Gershon, like, can we do some sort of earnout with the seller? Right? Let's say the seller wants $5 million, the business value is for $3 million. Like maybe you can do an earnout for $2 million, over the next couple of years. The short answer is earnouts are not allowed under the SBA rules. But one thing that we've been seeing a lot is when there's a seller financing component, buyers are including a forgivable component within the seller financing. Well, buyers and sellers. Obviously, the seller has to agree to it, but the idea is that it's kind of a workaround around the earnout to get around the SBA's prohibition of earnouts, where if the business does not meet certain historical milestones, then portions of that seller note will be forgiven over time, essentially. So let's say based on historically, the business did $10 million in sales annually. To simplify, perhaps the part of that seller note could be, hey, if we do not achieve $10 million, then 25% of the seller note will be forgiven and just wiped clean off the slate. So it really helps protect the buyer. So besides for keeping the seller with some skin in the game, it really helps protect the buyer. It keeps the seller engaged and in the game for much longer. And then also protects them from other things too. They could include other things that are tied to that will ultimately impact whatever those milestones are that the forgiveness is relying on. It protects from the seller misrepresentations, the seller not being truthful about certain things. Like what happens if you buy a business, right? And half the team leaves on a week into you taking over the company, right? So it kind of having this forgivable clause included in the seller note keeps the seller engaged and involved, not just post-close, even before post-close. He needs to ensure that you're successful. Otherwise, he's not going to see all his money. So I know I just threw a lot at you. I think I just spoke for 15 minutes straight. Okay, what else, Gershon?
We just have a few minutes left, and then everyone, we have a
Yeah,
survey in the last couple of minutes, so you can help us.
sure. There's definitely topics we didn't touch and things we need to discuss, but the clock's ticking, so whatever you'd like to address, or if you want to have questions,
so,
I'm down for that.
let's do one or two more for the next 3-4 minutes, then we'll open up for questions for the last 5 minutes.
Hmm.
Um, one question that I want to ask is, do they actually come after your house? If a business deal goes bad, what happens there? And then after that, any misconceptions? I don't know if that's a
Great. Okay, great question. It's a big topic, collateral. Okay, now inherently lenders cannot deny a deal because of a lack of collateral. So if someone doesn't have a house, he doesn't have any real estate, doesn't have any hard collateral, we do those deals all the time. Now, what happens if someone does have collateral? So the SBA says to lenders that you do not need collateral to get a deal through, but if the collateral is there, you may need to take it. So it is very common where how personal residences or investment properties are taken as collateral. Now, there are times when it's required, and there are times when it becomes at the lender's discretion. Okay, I'm not going to get into when, why, where. I'm happy to address that, in a follow-up, or if someone wants to email me, they're welcome to. Let's assume that they had to take a house as collateral. What that means is they're actually filing a secondary mortgage or even a primary mortgage on, let's just say, a personal residence to secure the business loan that they're giving, right? Now, what happens in event of default is the first thing they do is they're going to liquidate all business assets, okay? Then they're going to try to act on the personal guarantee. Now the short answer is I'm not the legal expert, but very rarely does the loan actually go to the SBA, where the SBA acts on the guarantee, and then it kind of starts the process of, recovering some of the other collateral and things like that. The short answer is this: if anyone's ever in trouble, most lenders want to work with you. Okay, they'll put the payment on deferral, they'll work out a payment plan where, okay, you got to get the business back up and running. Worst case scenario, they'd prefer a settlement over actually liquidating the business, right? They're not in the business of liquidating inventory and accounts receivable, right? So again, they're relying on it to an extent, but they'd prefer not to. So what I always advise people is try to work out a settlement with the bank. Okay, a settlement's definitely a very good option. And ultimately, if they do come after the house, I mean, there's a lot of laws that really revolve around this and vary state by state. But never let it reach that point where a lender says, "Hey, okay, what's the deal with the house now?" Where the SBA says that. It's kind of like I've heard this over the years. People tend to think that if they just ignore their problems, it will go away. Problems like this don't go away. So the best thing is to work together with the lender to satisfy what they're looking to accomplish. It's not in their best interest to go to the SBA either. It's kind of funny. They're relying on the SBA's guarantee to make the loan because the SBA is guaranteeing 75% of the loan. What happens is, though, if they go to the SBA and say, "Hey, company ABC is in default, we want to act on the guarantee," what do you think the SBA does? The SBA comes in, they audit the entire file, they make sure that the lender did everything to the T as required by the rules. If they feel that the lender did not act in good faith, they can invalidate the guarantee in whole or in parts. And then, you're talking about the lender's preferred lending status coming into play. And then maybe the SBA wants to pick up more files to review. So it's really not in the lender's interest to go to the SBA. So ideally, from a borrower's perspective, the business is in trouble. Go talk to your lender about it. Go be transparent. Try to work something out.
All right. Um, Jerry, thank you for all this amazing content. A lot of education, a lot of interesting stuff. We have 5 minutes. We're going to turn to questions. There's a couple of questions in the chat. One of them is basically saying, I have so many questions. How do I get all of them answered? Maybe we should do a follow-up. Again, you didn't get that one, but that was one
No.
question. And the other question, and we can, the other question is specific one. Can target on forgivable note be aggressive target, not based on historical numbers?
Well, it has to be it has to be based on historical numbers. That's just the way it is. That's the workout around, the earnout structure. It's got to be based on something historical. The idea is it can't be based on something prospectively. So it has to be based on historical numbers to make it SBA compliant, essentially.
Okay. One question about pricing. I think we discussed that. They can contact you directly.
Sure.
Um, Another question, does the SBA have a max leverage based on EBITDA?
So yeah, so remember, there's the cash flow and there's the valuation, right? The max they can lend is 90% on the valuation subject to cash flow. What is very nice though is that they could include working capital on top of that. If the lender feels that it's appropriate, the cash flow supports it. On the acquisition, they could do 90%, but they'll also hopefully make some working capital available as part of the loan. And I highly recommend that. Most businesses have a need for working capital in the first 6 to 12 months that they're taking over a company, and definitely recommended to talk to your lender to get working capital built into the loan.
Thank you. Can it be reasonable percent more than historical growth to account for growth?
It's got to be based on historical activity. That's it is technically a legal question, right? But how the seller note is structured, but you have to make sure it's SBA compliant. The basic eligibility requirement is that it is actually based on historical performance.
All right, last question that we have here. Everyone, by the way, we put the poll up. If you can answer the poll real quick, that would be very helpful. One more question. Is 2 years of ARR enough to engage for SBA compliance for newer tech, I guess for a technology company?
I'm guessing their question is if you have two, I'm not even sure what their question is.
I think the
The
question is if
point
you have a startup that has
Right,
revenue, but
right.
not
Okay, that's what I
necessarily
was thinking
profit.
the question is. That's what I was thinking
I
the question is.
assume.
The idea is the longer a company is established for, the more level of, the more level of reliance a company can place on the cash flows. And to get a lender on board, it would probably be easier for a company that's been around for 30 years versus a company that started up 2-3 years ago. The short answer is there's no minimum in business requirement to get a SBA, transaction done, but no lender's likely going to back a business that started 6 months ago. I would say 2 to 3 years, strong positive activity, and the lender will likely require some sort of seller financing as if the business is that new.
Okay, thank you. Any final questions? All right. If anyone wants to get in touch with Jerry, you can reach him at jerry@freedombm.com. You can also reply to the poll or reach out to us and we will make an intro.
Okay,
And
thank
if you
you
need
so
to
much,
reach us,
Gershon.
you're welcome. Thank you, Jerry. Great talk.
Okay, and if you want to do a follow-up, I'm definitely open for that. It's a big conversation. Like I said, SBA SOP is over 400 pages long, so we could go through the entire SOP if you want. No, I'm gonna
Okay.
pass on that.
That's going to be like a weekly 1 hour session.
Yeah, exactly. Yeah.
SBA SOP with Jerry.
All right, awesome.
All
Thanks
right.
so much, Gershon.
Thank you. Thank you to Jerry. Thanks to all our guests and have a great day. Thanks to Brittany for putting this together and have a great day.
Yep, bye-bye.
Bye-bye.